In today's video, we're going to be talking about tax on cryptocurrencies. Good day, my name is Heinrich Huvier. I'm the owner of SA Accounting Network. I had the amazing privilege to do an interview with a guy called Thomas Lobban from Tax Consulting SA. He is the legal manager for cross-border individual and crypto asset taxation at Tax Consulting SA. He was a co-author of a book called Expat Tax, South Africans Working Abroad and Foreigners in South Africa. He's a registered tax practitioner and he's got an LLM in tax law from the University of Johannesburg. Thomas's master thesis actually dealt with cryptocurrencies as a financial instrument in the Income Tax Act, so he is the right person to talk to when it comes to tax on cryptocurrencies. So let's not wait any further. Let me shoot down to the interview, then you can see what we discussed.
Very happy to be here today with you.
Thanks. Yeah, thanks, Thomas. So today, like I mentioned, we're going to be talking about the tax on cryptocurrencies. And I think maybe as a starting point, the place where we should start off is something that's maybe a bit more familiar, that's more easier understandable, is just how you deal with tax on shares. And I think if you start with that as a foundation, we can start building on that to start understanding how you actually deal with tax on cryptocurrencies. So I don't know, Thomas, do you just want to give a brief summary of how you would normally deal with shares, tax on shares?
No, absolutely. So shares are assets, as we all know. They can be held, they can be traded. When you hold a share, if you're somebody who regularly exchanges, buys and sells shares and moves them around and earns income from that, we call that as being revenue in nature. At the same time, if you hold a share for long enough, in terms of the Income Tax Act, 3 years or more, that share is then treated as capital gains tax. And I'm sure we can get into that a little bit more later. But with shares, you really have to determine what did you pay for it, what were your costs, what did you get for it when you eventually sold it, and how long did you hold it. Crypto goes a little bit beyond that. They are not shares, but they are assets. So there are certain principles that we can apply across, quite right.
Yeah, so I think maybe as the first question that I want to ask you quickly is just when must tax be taken into account with cryptocurrencies or crypto assets, if you can call it that way? What is the thing that triggers a tax event?
The tax event when it comes to crypto will be a transaction. So if you're somebody who has sold crypto for fiat currency, rands or US dollars, tax will need to be taken into account for that transaction. Similarly, the case if you swap one crypto for another, or you give crypto in exchange for other goods or services, these are seen as barter transactions. You're giving away something of value and you're getting something of value in return. The final area where you'd need to take tax into account is where you earn crypto. For example, if somehow you do work and you earn crypto as a reward, or you do what's called staking, or you place your crypto on an interest-bearing account, or you do mining, for example, and you earn crypto as a reward, that is also seen as taxable. So you need to determine your profit or loss at those points.
Yes. Yeah, just jumping back quickly to the thing that we talked about, shares, the basics of shares. I think what makes shares a bit more simple is that if I, let's say for instance, go buy shares in Telkom and I pay 100,000 Rand for those shares, and a year later I sell those shares for 200,000 Rand, there's a definite day when the transaction, when he bought the shares and the day when he sold the shares. And I think, and there's no other transactions happening in between. And I think what makes cryptocurrencies tricky is the fact that you can actually trade with it as well. So every time that you do a transaction, every time there's actually a disposal of a part of a share, if you can call it that way. I think that which complicates things, and that is where we need some masterminds to help us with it. I think, yeah, so I think the basics we understand is every time there's a transaction, there's a tax event that takes place, and on that day, there's actually a calculation that's got to be made to see whether they made a profit, whether they made a loss, and that profit, whether it's revenue in nature or whether it's a capital in nature. Am I correct in saying that?
Quite right. And you certainly do have those investors that reconcile on a daily basis. What is my position at the end of the day? But for a lot of the more casual investors, the guys who will trade every now and then, or those who trade in very high volume, they'll need to take that into account on a 6-monthly basis. What must be remembered is provisional tax. an estimate of your annual tax in every August or February in addition to your annual. So we would say that that regular, at least a monthly recon or at least a 6-monthly recon is best done to make sure that you keep up, because it's very easy to find yourself with volumes of transactional records that you now need to sift through.
Yes. We touched briefly on the different types of taxes, you know, whether it's in revenue in nature, which means that it will be taxed at normal tax rates, or whether it's a capital in nature. And I think that obviously leads us to the next question is, when will crypto transactions be subject to normal tax, and when will it be subject to capital gains tax?
Okay. Well, as you mentioned, normal tax is where the amounts are seen as revenue. So the normal rates, if you're an individual, up to 45, capital gains tax for individuals, maximum effective rate 18. Now, in considering whether an amount is capital or revenue, the first important consideration to remember is SARS' position is that in the overwhelming majority of cases, crypto will be seen as revenue, so subject to normal tax. And this is something that you can find, for example, in their capital gains tax guide that SARS issues. When you trade crypto on a regular basis, or you've performed a number of transactions, objectively, on the facts, you would see that this person intends to make a profit or an alternative form of income, even if they're not actively withdrawing that. That is regular transaction that's happening. So arbitrage trading would be seen as revenues. Active buying and selling and swapping, that's seen as revenue, as normal tax. When you hold crypto for a very long amount of time, it's not strict. You know, no one can tell you at least 6 months or a year or 3 years. There's no rule like there is for shares. But if on the facts you can see basically you're holding it for keeps, or you're holding it specifically for staking where you earn rewards from it, almost like a share where you earn dividends, but you're specifically holding it so that you can earn some form of derivative income, whether it's in cash or crypto, that can support an argument that it is capital in nature. The crux, however, is that you need to be able to prove on the facts to SARS that your intention was to hold it for keeps or mainly to get some other income from it, and not simply just to sell it at a profit as soon as possible and at its best advantage. So in those cases, it's very important that you at least consult with a professional who knows these differences and knows that case law background, the jurisprudential legal background behind making that determination, so that you can properly support that argument at SARS level.
Okay. Yeah, that makes sense. So it is a bit more complicated. So I think in shares there's a rule where they talk about the 3-year rule. So if it's longer than 3 years, capital gain most of the time. If it's shorter than 3 years, revenue in nature. So I think crypto becomes a bit more technical there, because there's a couple of extra questions that gets asked there.
Very interestingly, what we've now very recently found off the back of volumes of crypto relevant tax returns that have been submitted by our firm is that where there is just a handful of transactions, say 1 or 2, where it's been disclosed as revenue, normal trading income, we've now seen that where you give SARS enough evidence and clearly show those transactions, and SARS can see it's just a few, we've seen SARS auditors actually change it to capital for a taxpayer and make it subject to a lower rate of tax for them. So where you actually try to meet SARS in your obligations and evidence gathering and properly fleshing it out, SARS could actually meet you halfway and tell you, no, this is capital in nature.
That's indeed good news.
Yes.
Okay. Next question. We're talking about incurring cost. If you've been mining cryptocurrency, the cost of your computers, all those type of things, where does that fit into the picture? When do you deduct it from the proceeds that we get from our cryptocurrencies?
It's a very important question, that one. So you do have expenses that are capital in nature, and you have expenses that are revenue in nature, and these must be differentiated. Revenue expenses you would remove from deductions from your proceeds to arrive at your profit.
Yes.
So expenses such as the purchase price of crypto, or if you swapped another crypto for that crypto, what was the market value of it? And you also take into account fees. If you're running this, for example, as a mining trade at home, if you have a designated space like a home office, you can determine what was the electricity spend, what was the proportional data spend, etc. But when it comes to equipment and or assets that you use to make that income happen, we say differentiate between what is the tree and what is the fruit. The tree gives you the fruit, just like equipment allows you to do the activities that bring you that income. So equipment, like computing equipment, etc., that is capital in nature. So that can only be taken into account when you sell capital assets. You can't take equipment costs and capital expenditure into account, or you can't deduct that from your proceeds in trading, like deductions. So step one is always to differentiate which of my expenses was revenue, such as overheads and running costs, and capital, such as equipment and enabling costs to set up the infrastructure of the trade.
Yeah, that makes sense. And something like wear and tear, like depreciation and stuff on the computers, or would you keep that for the capital and transaction itself for the disposal there?
That we would keep for the capital disposal. We would not apply the wear and tear and associated costs for crypto.
Yeah. And next question, losses on cryptocurrencies. Can I deduct it from my other income? Can I do anything with losses that I incur? Because I think, wasn't there quite a big, there was something big that happened over December. I think there was quite a big dive in the cryptocurrency market apparently.
There was, and some would have described that as bloodshed. But when it comes to losses, first things first, if you are trading in crypto, yes, you can record a loss. And that loss can be carried over. So if you made a loss this year, you can carry that loss over to offset a profit in the next year. That can be done. But crypto is subject to ring fencing, which means that if you make a loss in crypto trading for 3 years out of 5, you won't be able to use that loss against any other profits except crypto until you fall out of that 3 out of 5 year time frame, until you start turning a profit more regularly.
Yeah, another question quickly is, if I've not withdrawn money from the platform, do I still pay tax on those profits and gains? So if I don't take any money out?
Yes, absolutely yes. The reason, or a very good example that I use is if I were a Ferrari salesman and I had a client come in and said, listen, I don't have 5 million rand for this Ferrari. What I do have is a house that I can give to you. If I accept that house as payment for a Ferrari, have I, as a Ferrari salesman, have I found the ultimate tax loophole? Unfortunately, no, I haven't, because the house is something of value that I am receiving for something else that I'm giving that's of value. So if I bought that Ferrari for 3 million rand and I accept a house as payment worth 5 million rand, that 2 million rand is my profit. Tax law in South Africa doesn't care about whether it's in cash or otherwise, so that must still be taken into account.
I recall a case that I read a couple of years ago about, I think it was a rugby player that traded services for a house. I think it was some in Pretoria, if I'm not mistaken. And they actually held this guy with VAT issues because it was a barter transaction, but there was never any output VAT declared on that transaction. So this guy got into deep trouble. I remember reading that case a while ago. Next question is, how are crypto assets valued, and what proof does SARS require of the valuation?
That is not always an easy answer to give. Crypto is not a centralized thing. You can't go to one place and see what the price of that crypto is. crypto assets will have a value given to them depending on which exchange or marketplace they're in or they're traded in. So if the transactional records that a crypto investor, usually in the form of a CSV, comma separated value file, if that doesn't give you the monetary values provided by the exchange at the time of each transaction, then it falls to the taxpayer to determine that price on that exchange if they can get that historical data separately. If they can't, then any reasonable method of valuation would reasonably be accepted by SARS. And one popular method, and certainly one that I found that we apply when need be, is to go on an aggregator, one of these websites, for example, that will take the aggregate price over 400 or 500 or more different exchanges around the world, platforms for crypto around the world, and they'll tell you what that aggregate price for that crypto was at that point in time across all of the exchanges. It doesn't work in every scenario, but it's a practical method of valuing your crypto transactions.
That's good, it does make sense. And I think this is something that I just want to clarify there as well. A lot of people are under the impression that they have to pay tax in the growth, but it's only actually when a transaction takes place that it's a taxable event. So if you buy cryptocurrency and the currency is now 500,000 Rand, 2 years later that thing is worth 300,000 Rand, it doesn't mean that you have to pay tax on the growth of the value. It's only once you actually trade with do the actual transaction that it becomes taxable.
Absolutely correct.
Because I think that's just a misconception that a lot of people has about those type of things. Another question, am I allowed to transfer crypto assets from South Africa to other countries?
Again, I'm going to do a little bit of a ballet dance here in answering this question, but bringing crypto into South Africa is not a crime. You're welcome to do so. It's just not something that's monitored by our financial surveillance department, FinServ, who traditionally do see the inflows and outflows within and out of South Africa financially. Sending crypto out of South Africa is not permitted currently, and it's a very contentious issue. And I call it an issue because there has been little to no regulatory guidance given. Reasonably speaking, while you can't send a crypto asset out of South Africa without Reserve Bank approval first, Reserve Bank is not giving that approval currently, they have not clarified when a crypto asset is deemed to be within South Africa in the first place. And I use a classic example for such as Luno. Luno has its headquarters in the UK. They have a significant presence, as far as I know, in Singapore, but they also have a bank account and operations in South Africa. Now, when I purchase 1 Bitcoin on Luno, where is that actually held? And that's something that regulators have now clarified. Certainly, if I hold crypto in cold storage in South Africa, like a hardware wallet, think of that classic example of a USB with cryptocurrency on it.
Yes.
If that's the case and I'm in South Africa, then it's open and shut. One can certainly agree, yes, that crypto was within South Africa. But crypto generally doesn't necessarily work that way. It's not like traditional finance. You know, an asset is not necessarily here or there. Crypto transactions are validated on a distributed ledger worldwide. It doesn't necessarily, or it isn't comfortable in one's mind to say that crypto is strictly held in one location. So until that's clarified, it is still up in the air. We have not heard of any prosecutions that have taken place in this regard, nor have we heard of anything incoming or impending.
That's good. And if I had to withdraw my money in a foreign bank account, what is the implications there? Is there something that I need to be aware of then?
Yes, and this is something that I often clarify with clients. It does not matter where the transactions take place, including when and if you withdraw, where it goes to or where it comes from. What matters first is whether you are a tax resident in South Africa. Now, provided you're living in South Africa, or until further notice, until you've made some declaration to SARS to the opposite effect, if you're living outside of South Africa, you're still a tax resident. What that means is that you're subject to tax in South Africa on your financial dealings worldwide. It doesn't matter where, how, whatever it is. If you've made an income, a profit, or a gain, you have to declare it to SARS, yes.
Okay. So now the big question, will SARS find me?
I get asked that very often too. The answer is yes. Sooner or later, we do find these things happening. For example, last year, tax returns filed. Obviously, people do their own tax returns. And I got contacted a few times saying, Tom, I filed my tax return. I've never touched crypto, but I've got SARS asking me questions about crypto, but I've never touched crypto. So that's one avenue. SARS is able to ask you questions off the back of your return. We call it a verification request, where they ask for documents and information to substantiate what you've put in your return. Or in the case of crypto, it can also cover what you have not put in your return. And if you lie to SARS, or if you should answer but don't, that is a crime. That is a crime. Whereas, take that as an opportunity to perhaps try and resubmit that return and correct that little issue. Another avenue available to SARS, which they'd exercised last year already, was reaching out directly to exchanges to give information on taxpayers. So SARS is able to collect your information in that regard, and they know that if you haven't made a declaration of your crypto activities, but they see, based on the information that they have available to them, you should have, you're going to find yourself in hot water there as well. And it extends even further. South Africa has a range of different international treaties, different international pieces of legislation that are active, such as automatic exchanges of information. If you have engaged with a foreign financial institution, such as through a deposit into a crypto exchange or a withdrawal, that information is given to SARS automatically. But at the same time, SARS has a further extensive network of double taxation agreements, call them double tax agreements, DTAs, tax treaties. They allow foreign revenue authorities to execute tax collection and investigation in collaboration with SARS. So if your assets or yourself are in another country, it doesn't necessarily mean that SARS won't find you or SARS won't be able to enforce. And now to cap that off, we've seen taxpayers go for a number of years, for example, 2-3 years, but in the third year, an audit was triggered, and the entire time until then unravels. So whether SARS does find you or doesn't, they are getting sharper, especially digitally, picking up on those breadcrumbs. And if they don't, presume they will rather correct it than look over your shoulder for the rest of your life, because there is no limitation on how far back SARS can go when they choose to look.
That's good. I heard a joke once. I want to tell you a joke quickly. But there's a SARS auditor and goes and visits Van's house. He stays up here in Sandton, a big house, 3 stories, 5 garages, 5 Porsches parked in the garage. The SARS auditor knocks on the door, opens, and the van opens up. He says, "Sir, I've got a problem with your tax return. On your tax return, it says that your taxable income for the year is 60,000 rand. But if I look at this, I can see it's a big house, 5 Porsches, 5 garages. Please explain this to me." So Van thinks a bit. He says, "You will never believe me. I had a dream one night, and in the dream, a man appeared to me and said, I have to go dig in the corner of my yard." And they said, "Because you'll find a bag of gold." And the auditor says, "Yeah, really?" He says, "Yeah." And what the auditor says, "What happens?" "No, I went and I dug in the corner of the yard, took out the bag of gold." So SARS says, "Where's the proof?" Van says, "Okay, look at the house and look at the cars." So unfortunately, that won't always work with the receiver of evidence. It would be nice.
That reminds me of that last avenue, which is actually lifestyle audits, which nowadays extend to social media as well. So if you're somebody who's vocal about crypto, it's a clue.
Okay.
But yeah, fantastic example.
For sure. So Thomas, I think 3 questions that we all want answered as well is if we know that we've got the historic tax on profits that we might need to deal with, or if we have to figure out what's my current tax liability, or in a future tax planning, where do we guys get hold of you? How can you guys help us? What services do you guys offer?
No problem. So we like to consult with our clients. We generally start with a phone call and we understand the situation. And every situation, of course, is unique. But we try to take as minimalist an approach as possible. We don't want to pull a thread and unravel, anything that was actually fine, legally speaking. So if you haven't declared your crypto, but it goes back a couple of years, and SARS has never, off the back of your returns being filed, asked for additional documents or information, perhaps it might be simply resubmitting your return and making sure that the crypto is properly calculated. And what we do is we generate a full report that can be used for SARS purposes. And we use that to inform that. In other cases, you might need to submit an objection to reopen an assessment. Or in other cases where you don't have other options available to you, or perhaps your actual liability puts you in a bit of a precarious, dangerous situation legally, we recommend that you make a voluntary disclosure program, VDP, application to SARS, which allows you to declare your outstanding tax to SARS for historic tax years without that specter of criminal sanction or heavy sanction hanging over your head. So you can simply regularize your affairs and get on with your life.
That's good. And in terms of current tax liabilities, can you assist people to, if they're sitting with a big portfolio of different crypto assets and stuff, can you assist them to work out what possible tax liabilities and stuff might be on that?
Absolutely, and we have worked very hard to lead this market in that vein. It starts with understanding what the full length and breadth of the transactions are. We need that transaction history. We collect that evidence, that raw documentation that you would also need to give to SARS. And we use that, as mentioned, to generate a tax report, which can almost serve the same purpose as an IT3B certificate that you would get from a bank. And we then make sure that the proper disclosure is made in the tax return, and wherever the liability can be mitigated by using deductions, any available exemptions, deductions, rebates, like any other taxpayer, we then have that declared and paid over. If somebody has inadvertently created a massive liability for themselves that they then cannot afford, we would still offer assistance there with a very comprehensive legal team who understands this area, such as a tax debt compromise with SARS, where you reduce your liability because quite simply you cannot afford this full tax amount. So like I said, every situation being different, we've found that any situation that's arisen, we've been able to comfortably handle.
For sure. Thank you, Thomas. Thank you for your time. I think for everybody watching the video, I'm sure that you guys got a lot of value out of this video. Go check out the website of Tax Consulting SA as well. You'll find a lot of information. Actually, you guys have a separate website for tax on cryptocurrencies as well.
We do. It's www.cryptotaxconsulting.co.za.
Yes. So please go check out that website as well. There's a lot of valuable information in there. Places where you guys can get a hold of people like Thomas as well. Once again, thanks for watching. Keep on hitting on the like button and remember to subscribe to my channel as well. See you next time.